As of Tuesday, Democrats secured the 60 votes needed to enact the biggest rewrite of Wall Street rules since the Great Depression. With us now to give us his reaction is Rodgin Cohen. He is one of the best-known Wall Street voices on regulation. He was in the room for every major decision during the credit crisis, and he has managed a Sullivan Cromwell, an 800-lawyer firm, for the past 10 years. He is senior chairman there. He joins us now right here in the newsroom. Raj, always glad to see you. With this reform, does it change anything at all for Wall Street? A lot of critics say it has no teeth.
You know, I would strongly disagree, Deirdre. This is a bill with substantial teeth. Regulatory requirements are clearly appreciating greatly. There is a new resolution regime. I think the administration's basic objective has been accomplished.
Can you talk about some of the consequences, unintended ones perhaps? I mean, is there anything that the banks, your clients, they've run all the models, they've looked at all the possibilities. Is there anything that might still catch Wall Street off guard?
I think most of them begin to understand the implications, but in every 1,500-page bill, unfortunately, there aren't too many. There are some very unpleasant surprises. One of them, for example, is changing the assessment base for FDIC insurance. So it hits the bigger banks, in my view, in a way which is totally inconsistent with good public policy. Another is eliminating the prohibition on paying interest on commercial demand deposits. That could be a very big number for a lot of banks.
How big, Raj?
Billions.
Billions of dollars worth of earnings are hit to the bottom line.
Correct.
Are there any unintended positive consequences for U.S. banks?
I actually think the consequences that are positive are mostly intended. If we have a safer and sounder banking system, funding should be cheaper over the longer term.
Because you and I spoke about what happened during the credit crisis and the fact that you said, you know, banks and governments were assembling sort of this equivalent to a nuclear arsenal of insurance and of cash, just trying to protect their own. Are we going to see the U.S. system as perceived more stable than perhaps their European counterparts?
I think we are, although there is one provision which I think is very troubling, and that is extending FDIC insurance on transactional accounts for 2 years without any limitation at all, and that could put pressure on banks around the world.
Does this regulation change anything for Goldman Sachs and Morgan Stanley? Full disclosure, your firm represents Goldman Sachs. Prior to the crisis, it was an investment bank, broker-dealer, switched its status. It needed access to the Fed's window to bank status, but it arguably no longer needs that. It's not lending money. What happens to the status, the label, for both of these two institutions?
No, it is very hard to go back once you have changed your status. And certainly this legislation does have an impact on Goldman Sachs, Morgan Stanley, J.P. Morgan, no question about it, in their basic business model. But I think this will be a change which is not revolutionary, and nor should it be.
So in other words, the legislation is not strong enough to want to make either Goldman or Morgan Stanley change their label.
I think at this point in time that would be a very difficult decision. And there are safeguards because they would still be regulated undoubtedly as systemically significant, even if they drop their bank holding company status.
And we imagine Goldman clients probably don't really care either way if the Fed is supervising them or not. I want to ask you, though, once reg reform seems to be out of the way now, I guess we can take it as a fait accompli, what are CEOs, what are the heads of these banks telling you they are most worried about?
I think it's quite clearly the economy. Banks are a service part of the economy. If the economy is strong, then banks will be strong. And if the economy is weak, it's going to be much more difficult for banks. So it's jobs, jobs, jobs.
So it's more the economy and not, for example, litigation and being worried about sort of the aftermath and still the public anger against Wall Street?
That should not be ignored. I don't think it's being ignored. But the economy, the growth in the economy will cure most of these problems.
All right. Rodgin Cohen, thank you so much for joining us, Senior Chairman at Sullivan Cromwell.